Welcome to this session of Physical Academy tutorial on decision tree. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, thank you for being part of this channel. What is a decision tree? Decision tree is a pictorial diagram that shows a series of interrelated decisions and outcomes on notes. A pictorial diagram from the word picture, pictorial from the word picture, a pictorial diagram that shows a series of interrelated decisions and outcomes on notes. In decision tree analysis, we have two types of notes. One, we have decision node. So decision node is like this. The node on a square. This is a decision node. This node is used where no probability of the cash flows are attached. This node is used where no probability is attached to a given cash flows. This node is used where no probability is attached to a given cash flow or to a particular cash flow. Where no probability is attached to a particular cash flows. So we use that decision node to represent that region when we are drawing the decision tree. So you have a cash flows without probability, then you use the decision node in that region. So that is for decision node. Then the second one is chance node. The word chance means probability. Chance node is a node on a circle like this or field. So this node is used where the cash flow of a particular, where the probability of a particular cash flow, where it is given. So this node is used. This node is used where the probability of a particular cash flows is given. So if you want to draw that region of that cash flows with the attached probability, then you use the chance node. I've told you the word chance means probability. So, and it is like this. So, what are the steps to take when solving decision tree? Steps in solving decision tree. Steps. Number one, draw and label the decision tree. Draw and label the decision tree. Remember, the decision node is used where information is given. Information about a cash flow is given and without probability. And I've told you where the cash flows comes with probability, then you use the chance node. So draw and label the decision tree. Then in decision tree, there are two paths. We have forward path and backward path. So step 2 is to determine the terminal values. The terminal values. That is ending value. So that is the meaning of terminal values. Terminal, where it terminates, where it ends. Determine the terminal value through a forward path. Determine the terminal value through a forward path. A forward path, that means the journey will start from the point of origin where the diagram starts. So the journey will commence from there and you travel to the terminal points. So that is, you go, that journey will be a forward path. And any cash flows you meet on your way will be taken into consideration when you are moving forward. When you are taking a forward path, any cash flows you meet on your way will be taken into consideration. Please bear that in mind. You determine the terminal value or values through a forward path. Then, now that the terminal value has been determined, the terminal value or values have all been calculated, then you determine the value of the internal nodes through a backward path. You also take a backward path again. Determine the values of internal nodes through a backward path using a highest payoff for decision nodes. So now, when you are taking a backward path, so if a particular node is a decision node, and you already knew what a decision node means, so you use the highest payoff. So the possible route that leads to that node through a backward path, you choose the highest value of it. That is highest payoff. B, expected value for a chance node. So where the value of the node you want to determine through a backward path is a chance node, you use the expected value. And remember, you know what a chance node means, the node on circle. So, and remember, we said expected value equals to probability times cash flows. Probability times cash flows will give us the expected value. Remember, I've told you for a chance node, there will be an attached probability. There will be an attached probability. So, having determined the steps for solving decision tree, we want to take questions as work example. Keep watching. Example 1. A company is considering whether to invest in a new project costing 12,000 naira, which has an 80% chance of being successfully developed. If it is developed successfully, the future cash flows from the project will depend on whether the economic conditions are good or poor. The present value of the future cash flows expected depends on the economic conditions, which are forecast as follows. We have economic conditions, we have good and poor. We have present value of future cash flows, 50,000 naira, and a loss of 20,000 naira. We have the probability for good economic condition to be 0.6, and that of poor is 0.4 required. Should the company undertake the project? This question is obtained from ICAN study test by Emily Wolf publishers. The question is in the FM study test, and the same question is in SFM study test. Let's have the solution. Solution. The company is considering whether to invest in a project costing 12,000 naira. So this company want to make decision. There are two possible decisions opening to this company. One could be to invest, and the second one may be not to invest in that project. So it means the company want to decide between two possible options, two possible alternatives. One alternative is to invest, and the other one is not to invest. Now, there is no probability attached to this option. No probability of cash flows is attached. So you use the decision node. Now, I've told you the node on a square, that is decision node. One is to invest. The other one is do not invest. Do not invest. So if you want to invest, it will cost you 12,000 naira. That is the cost of making the investment. 12,000. That is outflows. That is cost. Cost is an outflows. So if the investments are made, if the entity goes ahead making the investment, it will cost them the sum of 12,000 naira. Now, let's read further. Which has an 80% chance of being successfully developed. So it means if the company go ahead making the investment, the chance of the project being developed successfully is 80% chance. So no chance means probability. So the probability of successful product is 80%, while the probability of not successfully developed will not be 20%. So we have, since the probability is given, we use the chance node. Remember, I told you the node on a square, on a circle, that is a chance node, which has an 80% chance of being successfully developed. It means if the product is developed successfully, its chance of being successfully developed is 80%. So that is successful. And then the second option is not successful. So if it is developed successfully, the chance of it being successful is 80%. Probability of success is 80%, while that of not successful is 20%. 80% success, if you subtract the 80% from 100%, then you'll be left with 20%. So not successful will be 20%. If it is developed successfully, the future cash flows from the project will depend on whether the economic conditions are good or poor. So if it is developed successfully, they are particular about this. If it is developed successfully, the future cash flows from the project will depend on whether the economic conditions are good or poor. So that means you have two possible economic conditions. We have the good economic condition and poor economic condition. The present value of the future cash flows expected depends on the economic condition, which are forecast as follows. You have for the good condition and poor condition. These are the present value of the cash flows, and the attack probabilities are given. Since you have the probability, remember, so what brings about this condition? You were told 80% chance of being successfully developed, and we've done with that. If it is developed successfully, that means they are particular about this now. So it is, if the product are developed successfully, that you will have this possible economic condition, which are, you were told if it is developed successfully, the future cash flows from the project will depend on whether the economic conditions are good or poor. So the good economic condition or the poor economic condition all lies on the entity being able to develop a successful product. So since there are attack probability, then that means you will also use a chance node. So you have two possible economic conditions. You have good economic condition and poor condition. Poor. And the probability of good economic condition is 0.6. And that of poor economic condition is 0.4. The cash flows of good economic condition is 50,000 naira, while that of poor economic condition is loss of 20,000 naira. 20,000 naira loss. So, required. Should the company undertake the project? Should they undertake the project? So that is the question. So we've drawn the decision tree now. After drawing the decision tree, the next step is to label the decision tree. So step 1 is to draw and label the decision tree. So this is point 1, point 2, point 3, and 4. These are the possible points we have in the tree. So let's have these to be 5. Backward, 6, and 7. So we have drawn and labeled the decision tree. The next step is to determine the terminal value through a forward pass. Remember, I've told you the terminal value is the ending value. That is the ending value. These trees ended at 1, 2, 3, 4. That means you want to determine the values of point 1, 2, 3, and 4. Through what? Through a forward pass. I remember I've told you that if you want to determine the value, the terminal value through a forward pass, that you should always start from the point of origin and travel from that point of origin to the ending point. So the point of origin is it. This is where the tree started from. So now if you are starting from here, 12,000 is met as a cost. So let's say point 1, you have 12,000, cost of 12,000, outflows, you travel, so there is no income apart from probability. So you have inflows of 50,000. So we have plus 50,000. So minus 12,000 plus 50,000, that will give us 38,000. So that means point 1 gives us 38,000. We want to determine the value of the point 2. So start from the point of origin. You have 12,000 negative, 12,000 negative, plus. So you want to travel to 2. There is no cash flows. So the next cash flows is another 20,000 negative. You have minus 20,000. Minus 12,000 plus minus 20,000, that will be minus 32,000. Minus 32,000 naira. Then the next one is 0.3. So if you start from the point of origin, minus 12,000 is cost, minus 12,000. Then travel to that 0.3, no cash flows. So that means 0.3 will be minus 12,000. If you travel to 0.4, no cash flow, so it will be 0. You've determined the values at 0.1, 2, 3, and 4. So we want to determine the value of the interior nodes. And I've told you that if you want to determine the value of the interior nodes, you take a backward pass. A backward pass, that means you start from the terminal point and travel backwards. You want to travel to 0.5, you either take this route, you start from 1, you can reach that 0.5 as your destination. If you equally start from 2, you can travel to 0.5 at your destination. Remember, 0.5 is a chance node. And I've told you that to determine the value of a chance node, that you should use the expected value. And I've told you that expected value is cash flows times probability. So chance node 5. Chance node 5. Node 5. Since it is chance node, so you use expected value, so of 1 and 2. No 0.1 and 0.2. 0.1, we have 38,000. We have 38,000 times, what is the probability we have there? We have 0.6 as the probability times 0.6. That gives us 38,000 times 0.6. That gives us 22,800. 22,800. Then you can also use this 0.2, 32,000 negative. 32,000 times the probability we have there is 0.4 times 0.4. That gives us 32,000 times 0.4. That gives us 12,800. If you subtract 12,800, 12,800 is a negative. It's negative. So if you subtract it from 22,800, then you have 10,000 as your net cash flows. After 0.5, we have 0.6. Node 6. Node 6. And this node 6 is also a chance node. And I've told you the value of a chance node will be determined using or through the expected value. So you can start from 5 to, if you are, you are traveling backwards. So backward, we are taking a backward pass from 5 to 6, and you can also take 3 to that 6. So those are the two possible routes you can take. You can take 5 and you can take 3. Those are the 2 points you can take if you want to travel to the node 6. So at 5, what is the value of 5? And we have determined the value of node 5 already to be 10,000. So we have 10,000 times the probability. And what is the value of node 3? And that is minus 12,000. 12,000 negative times the probability. The probability from 0.5 to 6, that is 0.8. And from 0.3 to 0.6 is 0.2. So we have 0.8 and 0.2. So this gives us 8,000. Then minus 12,000 times 0.2, that gives us 2,400 negative. Minus 2,400. So if you sum them up, You have 5,600. So that is the value of node 6. Then this is a decision node. Node 7. We have node 7. Node 7. Being a decision node, and I've told you that to determine the value of a decision node, you don't use expected value. We don't use expected value. What we normally use is the highest payoff. To determine the value of a decision node, you use the highest payoff. Please bear that in mind. So that means it will be higher of 6 and higher of 4. Those are the two routes you can take if you want to travel to 7. So from 6, from 4. So we have higher of 6 and 4. 6 and 4. And we've determined the value of node 6 to be 5,600. And that of node 4 or 0.4, we have that to be 0. And the higher of the two, the higher is 5,600 naira. So that is the highest. The higher of the two is 5,600. What will be the decision? You know it is node 6 that gives you 5,600. And this is node 6. And what goes with that is to invest. So your decision now will be to invest in the project. So invest. So that is the solution to the question. Example 2. Kenny Limited is considering an investment in a new project with an initial expenditure of 60 million naira payable now. The net cash inflows in the following 3 years will dependent upon the success of the initial advertising, the cost of which is included in the initial expenditure. If it is successful, the net annual cash inflows will be 15 million naira. And if unsuccessful, they will be 10 million naira. There is a 70% chance of success. If the advertising is unsuccessful, then the project will be terminated in year 3 and the assets sold for 40 million naira. If it is successful, then there is a 60% chance of receiving net annual cash inflows of 14 million naira and a 40% chance of receiving 11.5 million naira in the following 5 years. In both cases, the residual value of the assets will be 4 million naira. The relevant discount rate is 14% required. Calculate the possible net present values which could result from the investment. And investment given the above information and find the expected net present value. Finally, what is the standard deviation of the project? So this question is obtained from ICAN study test by Emily Wolf Publishers. Financial management study test. The same question is also in ICAN SFM study test. You can also obtain this same question from Omoleiwa Workout Financial Management. Keep watching. The name of the entity is Kenny Limited. We have Kenny Limited. Kenny Limited is considering an investment in a new project with an initial expenditure of 60 million naira. The initial expenditure of the project is 60 million naira payable now. So, the net cash inflows in the following 3 years will be dependent upon the success of the initial advertising, the cost of which is included in the initial expenditure. So, now Kenny wants to undertake a project, and this project costs 60 million naira. The initial expenditure on the project is 60 million naira. 60 million outflows. That is the initial cost of the project, so which is 60 million naira. So, and you were told the net cash inflows in the following 3 years. So this cash flows is for the 3 years after the investment has happened. You have invested the sum of 60 million naira in the project, and you were told it will generate the cash flows, the net cash inflows in the following 3 years. And it will be dependent upon the success of the initial advertising. So the amount you will have as cash inflows will be dependent upon the success of the initial advertising that has happened, because of which is included in the initial expenditure. The cost of the advertising is included in the initial cost of 60 million. So that is what the question is telling you. If it is successful, now you have the condition now. If this investment and the advert, if it is successful, the net annual cash inflows will be 50 million. If it is successful, you have 50 million as an inflows. And if unsuccessful, there will be 10 million. So you have 2 possible outcomes now. Successful, not successful. If it is successful, you have 50 million as cash inflows. If it is not successful, the cash inflows will be 10 million naira. So there is 70% chance of success. You are given the attack probability to be 70%. So since it comes with the probability, then that means you are going to use the chance node. The 2 possible outcomes. One is successful, and the probability of success is 0.7. Then the second one is not successful, and that comes if the probability of successful is 70%. Not successful will be 30%, which is 0.3. And you were given the net cash inflows of both outcome, for the next 3 years. That is year 1 to 3. How much is the cash inflows? You were told if it is successful, the cash inflows will be 50 million, and if not successful, it will be 10 million. So we have 50 million naira for year 1 to 3. That is inflow. That is why I have it as positive. And 10 million naira only if it is not successful. That is for year 1 to 3 as well. 70% chance of success. If the advertising is unsuccessful, then the project will terminate in year 3. If it is not successful, it will terminate in year 3. That means if it is not successful, the lifespan of the project will be 3 years only. And the asset sold for 40 million. It will be sold for 40 million naira if it is not successful. So you sell the asset for 40 million. If it is successful, so they are particular about this now. If it is successful, then there is 60% chance of receiving net annual cash inflows of 40 million and 40% chance of receiving 11.5 million in the following 5 years. Now you have 2 possible options now. If it is successful now, you have 2 possible cash flows. And their attached probability, since the probability is given, so you were told 60% chance, 0.6, and 40% chance. You were told if it is successful, then there is 60% chance of receiving annual cash inflows of 40 million. So you have 40 million naira as your cash inflows if it is successful. 40 million naira as your cash inflows if it is successful. Then, and 40% chance of receiving 11.5 million naira in the following 5 years. So the chance of receiving 11.5 million is 40%. And that is 11.5 million. 11.5 million naira in the following 5 years. You have initial 3 years. Following 5 years means additional 5 years. Additional 5 years means if you add 5 years to initial 3 years, 3 years plus 5 years additional. That is following 5 years. 5 years after. So that will be 8 years altogether. So it means this 40 million, the following 5 years will be from year 4 to year 8. Year 4 to 8. That is when 40 million cash inflows will be received. This one too will be year 4 to year 8. That is when the 11.5 million cash inflows will be received. And remember, in both cases, you were told, in both cases, the residual value of the asset will be 4 million naira. In both cases, the asset has a residual value of 4 million naira. So if the residual value is 4 million naira, so that means you have 4 plus 4 million naira as residual value, then plus 4 million naira residual value. So, but remember, you were told if it is not successful, if the project is not successful, if the advertising is unsuccessful rather, then the project will be terminated in year 3. And the asset sold for 40 million. If it is not successful, that means this project will terminate in year 3. So it will not extend to 8 years. So that means not successful, it will terminate in year 3. Then the asset will be sold for 40 million naira. So we have drawn the decision tree. Now we can label the decision tree. They have this to be point 1, point 2, 3. Then after 3, you may have 4. Then you may have 5. So this is the decision tree, and we haven't drawn that. Then the next step is to determine the terminal value. Remember, to determine the terminal value, we normally take a forward pass. Don't forget. I've told you that you should always start from the point of origin. This is the point of origin. You travel to each of these, of the ending points. The terminal value, that means the value at point 1, 2, and 3. We want to determine the terminal value. Point 1 now. Point 1. So we have year, you have the cash flows. So the initial outlay is usually in year 0, and that is 60 million. 60 million as an outflows in year 0. Then in year, you are traveling to this point. So if you start from here, you have 60 million. You travel. So when you get here, you met 15 million on the way. So that is year 1 to 3. 1 to 3 years. That is 15 million. So you continue your journey. So through this place, you meet another 40 million. That is year 4 to 8. 4 to 8, 14 million. Then at the end of the project, the residual value is 4 million. So we have year 8. You have the residual value of 4 million. Then you now discount your cash flows. Your cumulative discount factor The cost of capital you are given in the question is 14%. You have been told the relevant discount rate is 14%, and the 14% is provided in the question. So the relevant discount rate, this is the discount rate. The relevant discount rate is 14%. So we want to use this 14% in discounting our cash flows. So now let's discount our cash flows. We have now, since the years are grouped in range, year 0 is always 1. Year 1 to 3, since it is grouped in range, that means you make use of annuity formula 1 minus r raised to power minus n, 1 minus 1 plus r raised to power minus n over r. Since the years are grouped in range, year 1 to 3, year 4 to 8, so you make use of the annuity formula in calculating the cumulative discount factor, which is 1 minus 1 plus r raised to power minus n over r. So which is 1 minus 1 plus r. R is 14%. 14% is 0.1. 0.14 over r, which is 0.14 raised to power minus n. Our n now, for year 1 to 3, you take your n to be 3. So this will be 1 minus 1.14 raised to power minus 3 over 0.14. You first of all evaluate what you have in the bracket. 1.14 raised to power minus 3. 1.14 raised to power minus 3. That gives us 0.67497. So that is what I have when I evaluated 1.14 raised to power minus 3. 0.674971516. That's what I have. So you now subtract it from 1. If you subtract it from 1, it will give you 0.325028483. Now divide the result by 0.14. Divided by 0.14, that gives us 2.321632027. So which is approximately equal to 2.32 to 2 decimal places. So the cumulative discount factor for year 1 to 3 is 2.32. So what is the present value of that? Remember, the amount is in million naira. 60 million times 1, that is 60 million. So 15 times 2.32, that gives us 34.8. 34.8. Now, you need the cumulative discount factor for year 4 to 8. How do we do this? To calculate for year 4 to 8, the first thing you should do is to calculate for year 1 to 8, the way we've calculated year 1 to 3. Calculate for year 1 to 8 in the same way. So for year 1 to 8 now, that will be year 1 to 8. That is, take your R to be 14% and N to be 8. So we have 1 minus 0.14 plus 1, 1.14 raised to power minus 8 over R. R is 0.14. So cumulative discount factor, it will be, so the way 1.14 raised to power minus 8, that gives us 0.350559054. So if you subtract it from 1, you have 0.6494. Then you divide it by 0.14. That gives us 4.64 to 2 places of decimal. 4.64. This 4.64 is the cumulative discount factor or factors for year 1 to 8. Remember, what you need is year 4 to 8. Year 1 to 3 is not part of it. It's year 4 to 8 you need. So you now have year 1 to 8, which is 4.64 minus year 1 to 3. And year 1 to 3, which is 2.32 as calculated earlier, 3.23. So if you subtract that, so you have 2.32 as well as the difference. That is 4.64. 4.64 minus 2.32. That gives us 2.32. So this is 2.32. So the present value, 2.32 times 14. Times 14. That is 32.48. 32.48. Now, this is for year 8 only, not grouped in range. It's not a range of years. It is just only 1 year that is involved. Since it is only year 8, so you make use of compound interest formula. This discount factor for year 8 now will be 1 plus r raised to power minus n, which is 1.14 raised to power minus 8. You know your n is 8. So 1.14 raised to power minus 8. That gives us 0.35 to 2 places of decimal. So 0.35 times 4, that gives us 1.4. So 1.4. So what is the NPV? What is the net present value of that? 1.4 plus 32.48 plus 34.8 minus 60. Then we have 8.68. 8.68. That is for the point 1. We equally want to calculate for point 2 and 3 the same way. Point 2. Point 2. We have year, we have cash flows. Year 0, you have your outlay of 60 million. Year 0, outlay of 60 million. You are traveling to this point. So when you go like this, you will have to read this place. Year 1 to 3, 15 million. 1 to 3, 15 million. So you continue your journey, you cross to this route. You have 11.5 million for year 4 to 8. 4 to 8, 11.5 million. Then in year 8, you have the residual value of 4 million. So what is the cumulative discount factors at 14%? So the same calculations we have done will be used. Know the cumulative 2.32, 2.32 and 0.35. So we can use the same value. So year 0 is 1, year 1 to 3, 2.32, year 4 to 8, 2.32, year 8, 0.35. What is the PV of that? Amount is in million naira. So minus 60. So 15 times 2.32, that gives us 34.8. 11.5 times 2.32, that gives us 26.68. Then we also have 4 times 0.35, that is 1.4. So if you sum them up, then you have 2.88. 2.88. That is the net present value. Point 3. So we have year and cash flows. Amount is in million naira. Year 0, we have the outlay of 60 million. Then we have year 1 to 3, inflows of 10 million. And year 3, we have 40 million. So we have discount factor at 14% cost of capital. Year 0 will be 1. Year 1 to 3 remain 2.32 as usual. 2.32. Then year 3. That gives us 0.67. 0.67. What is the present value of that? So we have 60 million times 1. That is 60 million. Outflows. 10 times 2.32. That amounted to 23.2. Then 40 times 0.67. That gives us 26.8. 26.8. So the net present value plus 23.2 minus 60. That is equal to 10 million negative. So that is the net present value for point 3. Now that you have determined the terminal value of the project, we can calculate the value of point 4 through a backward pass. So we want to take a backward pass to determine the value of the internal notes. So we have point 4. Point 4. Remember, I've told you to determine the value of the internal notes, you take a backward pass. So if you want to use the backward pass, then that means you will need point 1 and 2. So 1 and 2. That is, you can travel from 1 to 4. You can equally start from 2 to 4. So, and the point 1, the MPV is 8.68 as calculated. That is for the point 1. Therefore, point 2, our calculated MPV for the point 2 is 2.88. So, if point 2 is 2.88, 2.88 times the probability. From 1 to 4, the probability here is 0.6. 0.6 times 0.6. And from 2 to 4, we have the probability of 0.4. 0.4. So 8.68 times 0.6, that gives us 5.208. 5.208 million. Then 2.88 times 0.4, that gives us 1.152 million. 1.152 million. So if you sum up the two expected value, so we have 1.152 plus 5.208, and that is total 6.36 million naira. 6.36 million naira. So that is the value at 0.4. Then the next one is the value at 0.5. So you want to determine the value at 0.5. That means you will need 0.4 and 0.3. To get the value at 0.5, you will need 0.4 and 0.3. So at 0.5 now, so we need 4, we need 3. So the value, the 0.4 has been estimated to be 6.36, and that is on the board 6.36 million times 6.5 is a chance load. That means what you need is the expected value. So it's expected value. So this is a chance load. We need expected value 0.4. The probability is 0.7 here. We have 0.7 here. So we multiply our 6.36 by 0.7 in order to get its expected value. Then we can also start from 3 to 4, and we have determined the value at 0.3, and we got a negative NPV of 10 at 0.3, and the probability is 0.3. So the probability is 0.3. So if you substitute that, we have negative 10 negative times 0.3. So that will give you the expected value. 6.36 times 0.7, that gives us 4.452. 4.452. Then minus 10 times 0.3, that gives us minus 3. Minus 3. So if you subtract that from 4.452, and that is approximately equal to 1.45. That is the 1.45. That is the expected value. So we've obtained the expected value to be 1.45. What is the standard deviation of the project? You want to calculate the standard deviation of the projects. So, you know, 3 MPVs were calculated at the terminal point 1, 2, and 3. We have 2 terminal points, 1, 2, and 3. And we've calculated MPV at these 3 points. So, we have MPV, let's say we have points 1, 2, 3. Our MPV from our calculation, MPV is in million. So at point 1, our MPV is 8.68. 8.68. 8.68. At point 2, our calculated MPV is 2.88, and we have minus 10 at point 3. 2.88 and minus 10. So those are the results obtained from our MPV. We have 2.88 and minus 10. So now that we have this as our MPV, what are the probability? If you want to travel from the point of origin to point 1, you have probability of 0.7 here and 0.6. So we have 0.7 times 0.6. That gives us 0.7 times 0.6. That gives us 0.42. We have that to be 0.42. That is at point 1. The probability is 0.242. Then at point 2, if you start from the point of origin, 0.7 and 0.4. Those are the two probabilities. 0.7 times 0.4. So, what is the product of the two probability? 0.7 times 0.4. That gives us 0.28. 0.28. At point 3, the only probability we have here is 0.3 here. So, 0.3. If you sum up the 3 probability plus 0.3 plus 0.42, the sum of the probability is 1. So, that means 4. So, we have the 3 probability. So, the probability here, this one, 0.42, and this one, 0.28, and this one is 0.3. What is the expected value? Expected value means NPV times probability. So NPV is 8.68, and the probability is 0 times 0.42. So that is 3.6456. 3.6456. The second one is 2.88 times 0.28, and that is 0.8064. Then the third one, minus 10 times 0.3, that is 3. So if you sum up the 3 expected value, so the last one is minus 3 plus 0.8064 plus 3.6456. So the expected value is 1.45, which is the same with the result obtained from our earlier working. Standard deviation is the square root of variance, which is standard deviation equal to square root of variance, which is summation p into x minus x bar square. Note the x bar is the expected value, which is the mean expected value. So you will need x minus x bar. X minus x bar. If our x is the net present value and we have 8.68, x bar is the expected value, which is 1.45. So you can have 8.68 minus 1.45. So we have 7.23. 7.23. And by virtue of this formula, you will need x minus x bar square. So let's create that column. X minus x minus x bar square. And you will also need to multiply by the probability. Probability into x minus x bar square. So this is what we need. So if you square the x minus x bar, if we square that, our x minus x bar is 7.23. If you square it, that gives us 52.27. If you multiply that by the probability of 0.42 times 0.42, that gives us 21.95. 21.95. Then for the second one, 2.88, minus 1.45. That is equal to 1.43. 1.43. And if we square that, you have 2.04. 2.04 multiplied by the probability of 0.28 times 0.28. That gives us 0.57. 0.57. Then for the third one, we have minus 10 minus 1.45. That gives us minus 11.45. Minus 11.45. And if you find the square of that, you have 131. 131.10. Multiplied by the probability of 0.3. So we have 39.33. 39.33. So if you sum up this column, 39.33 plus 0.57 plus 21.95, and that is totaled 61.85. So if you find the square root of that, the square root of variance, this is the variance, 61.85, and the square root of the variance, that is the standard deviation. And the square root of our variance of 61.85 is 7.86. Therefore, the standard deviation is approximately equals to 7.86. This marks the end of the solution to this question. In my next video, I will solve a standard exams questions. Please drop the love emoji, like the video, also share it with others. Thanks for watching ACCA. Bye for now.